Index universal life policies, or IULs, are often sold as the perfect retirement solution: tax free income, market linked growth, and flexible premiums. But what if I told you IULs might actually be the worst options for retirement income? Here's the truth. While IULs sound great on paper, their hidden fees, rising costs, and market linked risks can sabotage your long term financial security. And today, I'm going to take you through why IULs don't work well for retirement, the risks that most agents won't tell you about, and why whole life insurance is a better alternative for building wealth and income. If you're thinking about using an IUL for retirement income, you need to see this before committing. First, let's get into how an IUL works. An IUL is a type of permanent life insurance that combines a death benefit with a cash value that grows based on the performance of a stock market index, like the S&P 500. Here's what makes the IUL attractive. The first is growth potential. Cash value can grow when the market performs well, but there's also a 0% floor to prevent losses during a market downturn. The next is tax advantages. Growth inside of the policy is tax-free, and loans from the policy are also tax-free. The third is they're going to give you flexible premiums, so you can adjust how much you pay, which sounds great for people who want flexibility. Agents often sell IULs as a way to generate tax-free retirement income by borrowing against the cash value. This is where the problems begin, as you'll see in the next section. So this is the problem with using an IUL for retirement income. The first is going to be the rising cost of insurance. So as you get older, the cost of insurance, or COI, will rise. With that, an IUL, the death benefit has to stay in place, which means the policy would need more cash to cover those insurance costs. If the market underperforms or you've borrowed against the policy, there might not be enough cash value to cover these costs, and at that point, you'll be forced to pay out of pocket or risk the policy lapsing. Imagine you're in your 70s and the cost of insurance has risen to thousands per year, and your cash value hasn't grown as expected because the market has had a bad few years. Now, instead of taking retirement income, you're scrambling to keep the policy alive. The next is going to be the caps on growth. So IULs have what they call a cap rate, usually around 10%, on how much cash value you can grow, even if the market performs better. So, for example, if the S&P, if it grows 15%, your policy might only credit you 10, while the insurance company keeps the rest. Over time, these cap limits limit your policy's ability to generate enough meaningful retirement income. The third one is the fees and charges, they never actually stop. So even if the market gives you a 0% growth, the fees are still taken from your policy. So these would include any administrative fees, cost of insurance charges, rider fees. These constant charges eat into your cash value, leaving you with less money to borrow for retirement income. The fourth one is loan restrictions and living benefits. IULs are often sold with living benefits, like access to your death benefit if you're critically ill or injured. But here's the catch. If you have an outstanding loan on your policy, these living benefits might be unavailable. This creates a dangerous situation where you've borrowed money for retirement and now you can't access the very features that you thought were protecting you. The last one is it lacks predictability. Retirement requires stability and predictability. With IULs, market performance, fees, and rising cost of insurance make it impossible to actually plan your income with confidence. While IULs look good in the short term, their long-term unpredictability and rising costs make them a risky choice for your retirement. That's why if you're looking for retirement income, I don't actually recommend an insurance product for this type of thing. But if you are looking at it, I always recommend a whole life policy if you do want to take loans or get dividends later on. What makes whole life different is whole life is going to be built on stability and long-term wealth building, which is going to be more ideal for retirement planning. So here's how it's going to compare to, say, an IUL. So the first is you're going to get guaranteed growth. Whole life cash value grows predictably every year, no matter what happens to the market. While whole life doesn't have as big of returns as an IUL can illustrate, typically over the long run, with the guaranteed rates and the dividends, the whole life is going to perform as well, if not better, especially in the older years when the cost of insurance is much, much higher. Policies from these mutual companies also do pay dividends, which boost your growth even more. The second one is going to be fixed costs. So unlike IULs, whole life premiums are going to stay fixed. While IULs offer more flexibility, the fixed cost of the insurance as you get old is going to benefit you more than having flexibility of how much you can fund the policy in the beginning. The third is going to be access to loans without restrictions. So typically when you're taking loans, if you're looking for retirement income, a whole life policy is actually going to be better because you can just change the payout of the dividend of that policy to pay out to you instead of going back into the policy. This is a great way to get retirement income and keep your death benefit while also leaving your living benefits available if you need to use it. Now, if you don't want to use the living benefits or anything, you can always take the loan out on that policy and then use that for retirement income as well. So whole life insurance isn't an investment. It's just a safe, strong vehicle for your wealth. Think of it as just a supercharged savings account that grows your money while keeping it liquid and secure. So here's how we're going to structure the whole life if you want to do retirement income. The first one is just going to be overfund the policy. So what this is going to be with any paid up addition rider to give the cash value a higher amount faster. Step two, we're just going to let it grow. Over time, this thing is going to keep going, and just be patient and allow the cash value to compound over several years. With these types of policies, you have to think long term. Finally, you're just going to borrow and recycle. When opportunities or emergencies arise, you're just going to borrow from your policy and pay yourself back with interest. And then when you get to retirement, just switch the dividend payouts. So in retirement, adjust the policy to have the dividends just pay out in cash, creating a tax-free income stream. IULs might look appealing, but their hidden fees, rising costs, and lack of predictability make them a risky option for retirement income. In contrast, whole life insurance offers stability, growth, and tax-free income you can count on. If you're serious about building a retirement plan that actually works, consider using whole life insurance as your foundation.